I want to talk about China as the swing factor. Just how important is it, Joachim, and how much are people underestimating the prospect that it stabilizes this year?
Yeah, well, Jonathan, I think China is a key factor for the global cycle. We saw that in the course of last year and the beginning of this year. So I think what was behind the sharp slowdown in the global economy last year, the manufacturing recession that we're now seeing in parts of Europe, was really the China deleveraging campaign, plus the trade tensions, which both combined led to a very sharp slowdown in Chinese growth in the course of last year. And that has continued until very recently. So we're still seeing China sinking lower. We're seeing the rest of the world sinking lower, and that slowdown has now arrived in the US, where I think we're in the midst of a very sharp inventory correction in the industrial sector. So I think China is the key swing factor. The important thing to notice, China hasn't bottomed yet. Yes, they've started with stimulus, so we're seeing triple easing, credit easing, we're seeing fiscal easing, and the trade tensions are easing. But so far, it's a relatively timid stimulus. You know, this is not the big stimulus that they did in 2015 or even in 2009. So only if the easing continues in the first half of this year, there's a good chance that we see some stabilization in growth in the second half of this year. So I think there will be some sort of a soft landing for the global economy. But in the meantime, as long as China is not stabilizing, I think you'll continue to see these air pockets lower.
So, Joachim, let's talk about the triple easing. The nature of the stimulus has changed somewhat. It's subtle, but it's shifted over the last few years. Is there reason to believe that that shift is enough to stimulate this economy? Because it's been going on for a while now, and I don't see great signs of the economy bottoming out in a material way.
Yeah, well, Jonathan, the easing has really, the credit easing really only started at the beginning of this year. So we've had 2 months where the credit impulse, which is the change in credit growth, turned positive. That's very early days. The fiscal easing, as you've noted, is different from past fiscal easings. This is not ramping up investment spending in a big way through the state-owned enterprises. This is more handing out money to the people. In the form of tax cuts, also to small businesses in the form of tax relief. And look, most of that stimulus so far seems to be saved rather than spent. So it is different, and that's why it's taking longer and why we should not look for a V-shaped recovery in China. If anything, it's going to be more like an L or a wok-shaped recovery, you know, where you see a softer landing and then a softer takeoff.
So, Joachim, when you speak to the portfolio manager at Pimco right now, what are they saying about what they expect to happen just in terms of the price action? Let's assume as a base case that China stabilizes. There's a decent argument to make that the market has already got in front of that view, given the price action we've seen in places like Europe, elsewhere in Asia and EM2. Is there a view that actually the market's already ahead of the optimistic side of this story?
Yes, Jonathan, we definitely think that the markets have probably run a little bit ahead of themselves, you know, particularly equities, but also the narrowing in credit spreads that we have seen has probably gone a little bit too far. So we would be cautious. We would like to fade this rebound in the markets. We are slightly underweight corporate credit, for example. We are cautious on equities because we think that earnings growth will slow very sharply. And while we don't think there will be an economic recession over the next year or so, there's a very good chance or risk that we see an earnings recession. So that's why we're a little bit cautious on risk assets at this stage, particularly given how well they have done since the beginning of the year.
So, Joachim, when you get together with the whole of the team and put together this cyclical outlook, one of the big themes that's dominating discussions here on the street is the next move of the Fed, whether it's a cut or hike. At the moment, it's a hold, and it might be a hold for the time being. But the next move, cut or hike, where do you guys come down on that?
Well, the next move may well be no move. So I think we live in a world where the Fed could be flatlining in terms of rates for an extended period of time. We call it flatlining at the new neutral. You know, our long-standing view that the neutral rate of interest is somewhere between 2% and 3% for the nominal Fed funds rate. We're smack in the middle of that range. And while that hasn't happened very frequently in history, we may be looking at an extended period where the Fed just moves sideways. And the reason is no major imbalances in the economy. The Fed has refrained from committing monetary overkill, as they've usually done in past cycles. So there's really no good reason for them to either cut interest rates in the near term or to hike them. And I think the hurdle to hiking rates or cutting rates is relatively high. right? I think the Fed needs to be convinced that they either have several hikes to do or several cuts to do before they move, because just moving once, it's probably not worth doing it because it could lead to a lot of volatility in markets. So again, flatlining at the new neutral, that's our mantra here at Pimco at the moment.
That's the mantra for you guys, and that's the story with monetary policy. Let's talk about the fiscal side of the equation. Interesting to see the MMT debate in the cyclical outlook, where you address the following, and I'm going to quote some of it. The recent prominence of MMT in the public debate is symptomatic of a broader paradigm shift away from discussions of fiscal austerity to a new mainstream view that fiscal policy should become a more active tool to stimulate growth, counter the global savings glut, and address rising income and wealth inequality. It's the signalling of the debate that I'm interested in here, Joachim, and you seem to be interested in the signalling of the debate as well. How important is this shift if it does transpire?
Well, I think it's an important shift, a very important one. It's been going on for some time. It's not just modern monetary theory, which, by the way, is a misnomer. It should really be called old fiscal theory, because it's the old idea that fiscal policy should be the main tool to achieve full employment and stable prices, and monetary policy just runs in the background and keeps the government solvent by printing money. So that's a fairly old idea that can work in the textbooks. In reality, I think it's probably naive or optimistic to believe that fiscal policy can really be moved up and down so flexibly, given how dysfunctional our political system is. But it is symptomatic of a broader debate. I think we live in a world where people realize, policymakers realize, that we cannot only rely on central banks to do the heavy lifting, particularly if the next recession comes around, but that fiscal policy has to play a more active role. And that's not just MMT. You know, there's also broader recognition that you can actually run higher deficits in an environment of new neutral interest rates if interest rates are lower. So if the interest rate is below the growth rate of the economy, we're actually not running into these fiscal constraints as early as one would have thought in the past. So fiscal policy, in a way, becomes the new monetary policy.